Right. Okay. Let's dive in. We've got this really interesting set of short posts here from Fundamental.
Yeah, from Gustavo Cano. They cover quite a bit. Policy, economy, markets.
They really do. And that's kind of the plan, right? To unpack these observations, see how things like policy, the economy, what the markets are doing, even currency, how it all, connects below the surface.
Exactly, giving you a sort of curated view of the undercurrents.
Yeah, getting the bigger picture. Because it feels like a really dynamic time. You've got legal fights, shifting economic data, global stuff.
Yeah.
Definitely not quiet, as one of the sources puts it.
Not quiet is a good way to describe it.
Mm-hmm.
These pieces offer a sharp take on what might be driving things.
Yeah, okay, so maybe let's start with the economic picture first. Seems like a good base.
Makes sense, yeah.
There's a source not aligned, and it suggests the latest U.S. data is, well, looking a bit worse.
Deteriorating is the word they used. It points to that first quarter GDP revision.
Right, it got revised up slightly, from minus 0.3% to minus 0.2%.
Yeah, so still negative, just fractionally less so.
Yeah.
Still shows contraction.
Okay. And not aligned also mentions other weak spots.
It does. Pending home sales, for instance. They dropped significantly, like 6% down when analysts were expecting a small rise, maybe 0.9%.
Wow, that's a big miss.
And jobless claims, too. Both the initial ones and the continuing claims came in higher than forecast. So not aligned basically pulls that together. Negative growth, weak housing, more people claiming unemployment benefits. That's the deteriorating picture it paints.
Okay, so that's the economic backdrop. Now, how does that connect with the policy side? There's another source, Convoluted, talking about a big court decision.
That's right. Convoluted digs into this federal court ruling that actually blocked President Trump's planned Liberation Day tariffs.
Blocked them? On what grounds?
Well, Convoluted explains the court found the president went beyond the authority given by that 1977 law, the International Emergency Economic Powers Act, IEPA.
IEPA, right.
The judge basically said, look, trade deficits on their own don't constitute the kind of national emergency that triggers these broad powers under IEPA.
Interesting. And these tariffs were pretty hefty, weren't they?
Oh, yeah. Convoluted notes they range from 10% up to 54% on imports. The stated goal was cutting the trade deficit.
But the court said using that specific power, the IEPA, for that reason was unconstitutional.
Precisely. A significant legal challenge. And Convoluted also mentions President Trump intends to appeal this, maybe even take it up to the Supreme Court.
And if the Supreme Court agrees with the lower court, what are the consequences discussed in Convoluted?
Well, potentially huge. The U.S. might actually have to refund the tariffs already collected to the exporters, including, places like China.
Refund them. Wow.
Yeah, and Convoluted raises the question, how does that affect the U.S. position in trade talks if this major tool, the tariffs, is suddenly ruled illegal or just gets taken off the board?
It definitely seems like it could weaken leverage.
Could do. And Convoluted adds another wrinkle. It mentions this OBB sounds like some kind of big spending or budget plan.
Okay.
Well, Convoluted suggests that plan was kind of banking on the money from these tariffs to help cover its costs, to offset a deficit increase. So no tariffs, potential funding gap.
Okay. So let's bring not aligned back in here. And also mention this tariff issue, right?
It did. Not aligned notes, the whole thing is likely heading for a court battle, but crucially, the tariffs stay active for now while it plays out.
Right. They're still being collected.
And not aligned also reminds us we're still, waiting for the Senate to act on that OBBB plan.
So Convoluted really hammers home this idea of friction, doesn't it? Asking if things aren't getting more convoluted.
Yeah, it talks about an internal fight between legislative and executive powers happening just when, according to the source, the U.S. really needs the income.
It paints a picture of, internal conflict. And there's another source, No Quiet Times, that sort of echoes this tension, right?
It does. No Quiet Times observes that the administration keeps poking the tray bears, using tariffs and strong comments.
Trying to force negotiations, maybe.
That seems to be the interpretation in the source, yeah. That it's a deliberate strategy.
Okay. And speaking of high-level stuff, not aligned had that bit about Fed Chair Powell meeting the president.
It did, yeah, yesterday. And not aligned highlights how quickly a statement came out afterwards.
What did it say?
Basically just a routine update, but strongly emphasizing the Fed's unquestionable independence. A very clear message there.
And reiterating that rate cuts are purely about the economic data.
Which, as we just discussed from the same source, not aligned, is looking a bit weak.
So it feels like a deliberate signal about keeping politics out of monetary policy.
That's how not aligned seems to frame it, yeah.
Okay, so if you kind of synthesize what not aligned is saying across these points, there's this feeling that things aren't well aligned, that Congress, the Fed, the White House, they aren't really pulling together on these big debt and spending issues.
That lack of cohesion, that sort of institutional friction, really seems to be a key theme emerging from these sources.
Okay, so let's shift gears a bit. From policy and the economy to what the markets themselves might be telling us. The source, No Quiet Times, makes an interesting point about the stock market.
It does. It finds it pretty remarkable, actually, that the S&P 500 is still hovering near its all-time high.
Despite all the things we just talked about, global trade friction, U.S. debt worries.
Exactly. It seems like a disconnect. Then No Quiet Times looks at the bond market using z-scores.
Refresh my memory quickly.
Sure. It's just a statistical measure. Tells you how far a data point is from its average in terms of standard deviations. So No Quiet Times says bonds look cheap right now based on their historical z-score.
Cheaper than average?
Right. While equities, using the same measure, look expensive.
Okay. And does No Quiet Times give specifics on the bond's z-score?
Yeah, it mentions bonds are around a Manowit 1 z-score now, so one standard deviation cheaper than their historical average price.
But is that extreme?
Well, that's the context No Quiet Times provides. Back in the 1980s, they hit -3.
Ah, okay, so 3 standard deviations below average.
Exactly. So the point from No Quiet Times is, while bonds might look cheap now relative to history, we've seen much more extreme levels before. There's room, historically speaking, for a bigger move.
Got it. And No Quiet Times also looked at volatility, like the VIX.
Yes, the VIX for stocks and the movie index for bond volatility. It notes they spiked around that Liberation Day tariff announcement. Then they settled back down a bit, but they're still higher than you'd typically see in really calm, quiet market periods.
So still elevated.
Right. And the conclusion No Quiet Times draws is pretty direct. We're not in a quiet period. It suggests these higher volatility levels mean the market is kind of bracing itself, that we're waiting for something big to unfold.
That waiting theme keeps popping up. Now let's look beyond the U.S. There's another source, Waiting for the Last Straw. It makes the point that debt issues aren't just a U.S. problem, right?
Absolutely not. Waiting for the last straw makes that very clear. It points to places like Germany, the UK, Japan.
What's happening there?
Their long-term government bond yields have jumped up pretty sharply since inflation became a big global story again around 2022.
And higher yields mean lower bond prices.
Exactly. More expensive for those governments to borrow. And interestingly, Waiting for the last straw contrasts this with China.
What's happening in China?
Yields there are actually falling. Plummeting, the source says, because their economy is slowing down.
So different pressures in different places, but the volatility in major bond markets like Japan, waiting for the last straw, questions the whole bonds are safe idea.
It really does. It challenges that traditional view of bonds being way less volatile than stocks. The source gives a striking example. 30-year Japanese government bond yields, JGBs, they jumped 50 basis points, 0.5% in just 1 month.
0.5% yield increase in a month. What does that mean for the bond's price?
According to Waiting for the Last Straw, it resulted in a 7% loss on those bonds in just 30 days.
7% on a government bond. That's not low volatility.
Not at all. And Waiting for the Last Straw highlights a really critical potential outcome here.
Which is?
If bond auctions, where governments sell their debt, start seeing weak demand, if buyers kind of desert the auctions at current yields,
then governments have to offer higher yields to attract buyers.
Exactly, which pushes up their borrowing costs even more.
And that matters because?
Because, as Waiting for the Last Straw points out, government bond yields are like the bedrock for valuing almost everything else in finance. If the foundation gets more expensive, it affects all asset valuations.
Right, but are governments acting concerned, according to the source?
Yeah, apparently not overly. Waiting for the Last Straw observes that governments seem to be pushing ahead with big spending plans anyway.
Which leads to the title of that source.
Precisely. It brings Waiting for the Last Straw to its main idea. This sense that we're waiting for the straw that breaks the camel's back. Some point where the system just can't take the pressure anymore.
That phrase really captures the mood. Okay, so that brings us to the currency itself. There's a source called debasement. It talks about the penny.
Yeah, it sounds small, but debasement uses the phasing out of the U.S. penny as a kind of symbol.
Phasing out. How so?
Well, debasement explains the U.S. Treasury has put in its final order for the metal discs, the blanks, used to make pennies.
No more blanks, no more penny.
Essentially, once the current supply runs out, likely by early 2026, according to the source, production stops. And debasement points out why. It costs almost 3.7 cents to make 1 penny.
Costs more to make than it's worth. Makes practical sense to stop.
It does. But debasement frames this decision as another sign of a bigger trend. The debasement of the U.S. dollar itself.
Debasement. The source gives historical context for that, right?
Yes. Debasement makes the point this isn't new. It uses the Roman denarius as an example. It started as a silver coin, but over time, the silver content got diluted until it was basically worthless, lost its value, nobody accepted it anymore.
So how does debasement say that happens now? Not by mixing in cheap metals, presumably.
No, the modern equivalent, according to debasement, is exponential growth in the money supply.
Printing money, basically, or creating digital money.
Yeah, fueled by big government spending. The source mentions things like wars, major programs financed either by piling up debt or having the central bank create money, or often both.
Okay. And how does debasement suggest you can sort of track this process, see the effects?
By looking at the price of tangible, scarce assets measured in that currency. Historically, gold and silver. And debasement adds Bitcoin to that list now.
And what does it say about their prices?
That they're near all-time highs. Not just in U.S. dollars, but in basically every major fiat currency. And the source suggests they're likely to keep rising.
Which is a perfect lead-in to the last source we wanted to discuss. Uncomfortable reminder, focused on gold.
Right. Uncomfortable reminder starts by saying gold is still, well, misunderstood. And most investors don't own much of it.
Even though some big institutional players are maybe saying it's overvalued.
Exactly. So if it's not the average investor, or even all institutions pushing the price up, who is?
And uncomfortable reminder points a finger.
It identifies central banks as the key buyers, especially the People's Bank of China, the PBOC.
China's central bank.
Yeah, the source calls them massive buyers and says they're trying to diversify their reserves, move away from holding so many U.S. treasuries and U.S. dollars.
And uncomfortable reminder sees an irony in this.
A huge irony. It points out that the guardians of the fiat currency system, the central banks themselves, are buying up gold, which the source calls the system's nemesis.
While their own governments keep running up debts and deficits.
Which, according to the logic in these sources, is what fuels the debasement that makes gold attractive in the first place. It's quite a loop.
An uncomfortable reminder mentions the ECB, the European Central Bank, too.
Yeah, it says the ECB has apparently started saying publicly that gold's rising price is becoming a problem, a stability issue for the system they manage.
A problem because?
Because, as uncomfortable reminder suggests, gold competes with the central bank digital currencies, the CBDCs, that they apparently desperately want to implement.
Why the desperation?
Maybe, the source hints, because they fear this potential new world order, that's the source's term for a big systemic shift, might happen sooner rather than later.
Wow. So the main takeaway from uncomfortable reminder is that gold's price isn't just a market thing.
No, it acts as an uncomfortable reminder. A reminder that governments and central banks seem to lack the fiscal discipline needed for the current system to last forever.
And the source concludes, every time gold goes up, say $100.
It feels like a step closer to some kind of new system, even if we have no idea what that system looks like or who'd be in charge.
It really frames gold's rally as a symptom of deep systemic stress based on that source's view.
Definitely.
Okay, wow. We've really woven together quite a few threads here from these fun mental posts by Gustavo Acano.
We have. We've seen that friction between policy aims and court decisions, the economic data maybe pointing downwards.
Yeah, I looked at those confusing signals from markets, stocks high, bonds looking historically cheap, but volatility saying, things aren't calm.
And broadened out to see similar debt pressures hitting bond markets globally, making people question old assumptions about safety, potentially raising borrowing costs everywhere.
And then tied it all back to the currency itself, the idea of debasement, symbolized by the penny disappearing and underlined by gold's rise, with central banks themselves being major buyers.
Yeah, these sources really present these as interconnected pieces of a larger puzzle, painting a picture of a really complex, maybe quite fragile financial and economic setup right now.
And pulling these points together, as we've tried to do, hopefully helps you make more sense of the headlines, right? Gives you a framework for thinking about what might be coming down the line.
It adds that deeper context, yeah.
Absolutely. So just thinking about The themes from these specific sources, this lack of unified action on debt that not aligned, hinted at, the stress signals in bonds from waiting for the last straw and that idea of waiting for a breaking point, plus the market volatility in no quiet times, and then central banks buying gold as that uncomfortable reminder pointing towards a potential new system.
It really leaves you with that question from No Quiet Times, doesn't it? If we're waiting for something big to unfold, what could that actually look like? And how fundamentally might it change the financial game as we know it? Definitely something to mull over as you watch events unfold.